welcome back to the Investing Show. We're joined here by the manager of the Schroder Recovery and Schroder Income Fund, Nick Kirrage. Nick, welcome to the show.
Thanks for having me.
So Nick, you're a value investor. That value bloke, as we were just talking about before we came on air. Tell us a bit about value investing and why you think that's the way forward.
It's funny, it's one of those things that if we were sat in the US right now, we'd all have a chuckle about that question because, of course, everyone knows what a value investor is. But here in the UK, it's not a very well understood concept. We don't have a style-based investment culture. We invest along geographic lines or income or growth, but we don't think about value as a style and that style of investment. It's funny that because actually value investment has a very kind of long and impressive history going back to the 1930s. And it's a style of investment that looks to try and put clients' money into the cheapest parts of the market, which of course all fund managers are looking to do. But as you filter the market out based on screens and look at what is incredibly out of favour, what you see back through time is that very unloved sector actually performs disproportionately better than all other companies in the market on average, and you can reap a very, very nice return by consistently coming back to those unloved sectors. It sounds very obvious, very simple, and shouldn't everyone do that? But psychologically very difficult, and I'm sure we'll come on to talk about some of the companies that today are in that unloved bucket and why, even though history tells you to look at them and value investing is based on doing that, it's incredibly uncomfortable to go there.
And value investing can fall one of two ways, really, can't it? It can fall down the sort of the cigar butt idea, where basically you're just picking up, there's a bit left on it, or it can fall more down the quality end, where you marry in the kind of quality end of it. Do you fall towards either end or down the middle there?
It's funny, and that exact characterisation is one that we hear a lot. And within the world of value investors, there are those two camps, the kind of quality value, the Warren Buffetts, if you like, and then the deeper value investors. The father of value investing, Ben Graham, the 1930s, he was one of those deep value investors. And what we've seen is there's just been a huge migration towards quality value because, of course, many of the great franchises out there, the staples companies or tobaccos companies, you look back 15 years ago, they were value investments. They were very, very cheap in the early 2000s in the TMT boom. And so you were able to pick up great companies at quality investments at low prices. Today, the kind of stocks that we see in the cheapest bucket, in the value bucket, are things like banks and commodities. And people find it very hard to think that those might be the staples of tomorrow, that the valuations will be the piece that gives them the great returns. And I think that's something that is playing towards a value investment style at this point. It's just very out of favour. It's not performed nearly as well as that quality investment franchise. And looking at some of those deeper value companies today, I think it's probably a good time to start exploring it as a style.
Does the fact that the landscape has changed so much, particularly in the States, play into this at all? For example, obviously up until reasonably recently, US companies would be based on fixed assets and what they actually owned and had, whereas as we're seeing now, increasingly, particularly with tech stocks, there's more kind of goodwill in there, trademark, copyrights, etc., more sort of intangibles. How does that feed into the difficult job that you've got?
It's quite interesting because originally, conceptually, value investment, you can pick any. It doesn't say which valuation you look at, which valuation metric. And back through time, many people did look at a book value, a tangible book value, tangible assets as a good measure. And I think that still holds true for many businesses today, banks or asset-heavy businesses. But as you point out, there are many companies for which that's probably not a good measure of value. A Microsoft, for example, or a tech company where a huge amount of the value is in software and IP and so on and so forth. The way we like to think about value is to screen the market thinking about average profits. So if you took the last 10 years of profits for a company and you put it into an average and said, that's broadly what a company should make over time, what is that when I compare it to the share price, an average PE? And that gives you quite an interesting mix of businesses and allows you to look at companies that have assets and those that don't, and not differentiate, but it highlights all the companies that are most out of value, and it's the first starting point for all our investment work. Of course, there's a huge amount of stock-specific analysis that goes on after that. The screen is not picking stocks. But by using the screen to fish in the cheapest 20% of all markets, we're giving ourselves an edge. We're kind of cheating, really, because we know that cheapest 20% over time always outperforms. And so by fishing there, we're kind of giving ourselves that edge for our clients.
It's a long-term game, though, isn't it? It's not something where you can expect well, you can get very good short-term returns, but it's often one where you have to sit it out, and sometimes sit it out through some fairly tough times. So do you look at some of those, when you look at those companies, what's the process that you then go through to say, right, I've got these cheapest companies, and now I'm going to try and pick out the ones that I think are going to do best?
I mean, it certainly is a long-term game. And I think, for anyone who's been in the market for the last kind of 10, 15 years, it's become increasingly difficult to be long-term. The availability of price information, clients with the internet checking their portfolios every day. It used to be that everyone said they were a long-term investor, and these days it's incredibly hard to hold that line. I mean, our average investment time frame for all our stocks is around 5 years, so we've got a turnover of 20%. As I say, that was a normal thing, go back 10 years. These days, you're very much in the minority with that. We're obviously, we're trying to shorten time periods and get all the upside as quickly as we can, but market timing is very difficult. So we don't try to differentiate and say, well, I think we're near the bottom. I think one of the ironies people often ask, is there a catalyst? And the irony, of course, is if there was a catalyst and we knew exactly what that catalyst would be, the shares wouldn't be cheap because everyone would have moved in advance of that. So what we're looking to say is there could be many catalysts for this, and we can come up with some interesting scenarios to what might happen. We don't know which might be true, but over 5 years, we just think the shares are worth demonstrably more, perhaps double in many instances or better, and we can wait. We're willing to be patient. If something does go up 100%, for example, and it takes 5 years, that's still a very handsome return in the context of equity. So, I think patience is a virtue. It's incredibly difficult in today's market, increasingly so. But for those who can hold the line, I think the returns are disproportionately higher because there are so few of us who are doing it.
And where do you see that value at the moment? What's interesting to you right now?
Well, the dispersion in the market between what's cheap and what's expensive is starting to blow out again. So I think, often what we say to people is, as an investor, I want to come up with clever stocks you perhaps haven't thought of or heard of before and buy them for you. But actually, quite often what my job is to do is to take the stocks that you've all heard of, you just don't want to buy, and buy them for you. Mm-hmm. And I think banking falls into that camp very much today. Banks are incredibly unloved. The valuations of many of those businesses today, post-Brexit, have gone back to, they've been weak for a long time, but with the subsequent falls after that event, they've gone back to the lows of 2009. People are concerned in the way they were back there. The uncertainty is very high, but I think the big difference, even though the world may be as uncertain as it was back then, is that the balance sheets of these businesses are 7 years better. 7 years of de-risking and of increasing capital. And one of the things we're thinking here when we look at those valuations is there could be another deep irony in the market, which is that people perceive banks, I think, as being one of the riskiest places you could put your money. But it may well be that, in stark contrast to many other sectors that de-risked for a couple of years after the last downturn, banks have been de-risking continuously for the last 7, and as a result it may ironically turn out to be the safest place you can put your money if there is to be a further downturn because of all that capital that's built up. Question mark? But certainly they're standout cheap in the context of most global markets.
I mean, if you go back to 2009, I remember sitting there, writing about the financial crisis, and the question was, is HBOS going to go bust?
Yeah.
That was the question. We were asking whether these banks, is Barclays going to go bust? And it's actually hard to think back to that time today, I think, because it seemed very surreal, at the time, and it seems even more surreal now, I think, even though we've only just been through it. So I guess the question with those banks you're asking yourself is, do I think they're going to go bust? And presumably the answer is, no, I don't. So they're undervalued.
One of the things I find quite interesting about that sector is that clearly there hasn't been a great deal of capital growth over that time period. The tangible assets, come back to where we started, have not really grown for the sector. But neither have they massively reduced in that time period. After the initial capital raising and underpinning of balance sheets in 2009-10, the tangible assets for the sector have not sunk massively in that time over the subsequent 7 years. And that's despite large write-offs, bad debts, PPI headwinds, other regulatory headwinds and fines, just a plethora of hard pills to swallow over that time period that have hit those books. Now, a double-dip recession, all those things. Now, let's say I thought the next 6 years were going to be as bad as the last 6. And the last 6 were amongst the worst financially in global markets that we've seen for decades and decades. But let's say I thought that. In that environment, it would probably be reasonable to say perhaps book value, tangible book value, could be maintained. as it was over the last 6 years. Well, if my downside scenario is flat book value and I pay less than half tangible assets for these businesses, and my upside scenario is potentially much better, that seems like a reasonable place to put clients' money to work. Those kinds of investments, downside not huge, upside potentially huge. That's the kind of thing you want to be doing for clients. We don't want to take no risk for our investors. They want us to take risk, but they want us to take mispriced risk. And I think banking is a classic example, one of several examples, though there aren't dozens of these in the market today, it has to be said, with the FTSE where it is. But one of several examples where you can take a genuinely mispriced risk and make a return for clients in the future.
And you further calibrate that without being too broad brush, deliberately. You might say HSBC Global, Barclays, lessening investment banking, Lloyds UK, RBS, long way to go, whichever way you look at it.
Yeah.
So do you further calibrate it, or are you completely driven by this stock looks of particular value to us?
Yeah, I think there's a kind of, clearly most banks are being treated as you're a bank, and therefore you have a low valuation, and within that there are better and worse depending on the view of safety. Within that we do characterise by the kind of thing you're doing. So Barclays, obviously you have a particular investment banking exposure. Lloyds, you have a very pure domestic UK loan exposure. Standard Chartered, you have a very emerging market oriented exposure. And RBS, you just have all the bad exposure from pretty much everything in the world. As far as I can see, this is what people say. But actually, that's quite a good example of a stock where things have changed. RBS 7 or 8 years ago had nearly £300 billion in investment bank, and today have almost nothing. So these businesses are changing, and we've got half an eye on that. But we do think about it. When you're thinking about a Standard Chartered, Asia has not seen anything like the downturn that we've seen already in the UK or in Europe, and so probably has further to work through. But that also needs to be put in the context of many of these businesses have 3 or 4 times the amount of capital they did back in 2009. So we start from a stronger position even with the Asian franchises.
So which of those banks are your favourites then at the moment?
It's like asking me to pick between my children. No, to be honest with you,
we hold all of them then?
We own all of the UK domestic banks to a greater or lesser extent. So slightly more for Royal Bank or an HSBC, and much, much less for a Standard Chartered, for example, or a Lloyds, where we think the valuation isn't quite as attractive. And we differentiate, we diversify across these different stocks, because in all honesty, you just don't know what the future will bring, and we don't want our entire portfolio to be banking focused. We also want to invest in other areas we think are cheap, like commodities or supermarkets, and diversify across all of them. But within the UK market, banking has a particular confluence of attractive valuation, and we think much lower risk than people perceive, that makes it attractive.
And those supermarkets, again, you like the look of those supermarkets from a value perspective, because again, that's a super unloved sector, isn't it? It had a little bit of an upturn, and then it's just got the downturn again, hasn't it?
Yeah. I think we do think there are attractive aspects to supermarkets, particularly in Morrisons and Tesco's, which are quite different businesses if you think of the other opposite end of the spectrum in many respects. Tesco's the large, diversified international operator, and Morrisons are very UK focused with a particular northern exposure and so on and so forth. So quite different businesses. But actually, supermarkets is a great example of an area where everyone has one narrative, one story. They're going to be killed by a combination of online and hard discounters like Aldi and Lidl. I think to the Aldi and Lidl point, to say that supermarkets are going to have their lunch eaten by incumbents by new entrants into the market, yes, they're powerful, they're supported by big parent companies, and they have advantages. But these are some of the Tesco and Morrisons and Sainsbury's, some of the biggest businesses in the whole of the UK. Their scale advantages are enormous, and they won't take it lying down. And in the end, supermarkets, there is an oligopolistic nature to this. Perhaps they were a bit too sanguine about the challenges 5 years ago, but they're awake to it now, and they're being incredibly competitive. And I think that will start to feed into the business models of an Aldi or Lidl. If suddenly your like-for-likes, which were growing 20% per annum, are flat, which is what we saw over last Christmas, it starts to feed into your mentality about how aggressively should I be expanding in this market now with these sleeping giants now awake. I think on the internet, this is a narrative we heard 5, 6 years ago with the high street. Amazon are going to kill a Dixons and a Home Retail and all these businesses. And what that fundamentally missed was it's the brand that has value. The way you sell it, the channel, is an opportunity as much of a threat. i.e. it turns out that Home Retail and Dixons are two of the biggest online retailers in the UK as well. Plus, it's not very easy to post a sofa through your door. So, when you're thinking about what some of these supermarkets are selling, that's about slick distribution and about sensible cost overhead and structuring. They've been doing that for many, many years in their core businesses. So I think there are opportunities as well as threats. And the most important thing after all these points we discuss is the shares don't discount any upside. They discount a very, very negative scenario. So if huge sways of the downturn are already priced in, talk about taking sensible risks again. That's a good risk to take.
Nick, that's all we've got time for. On that glass half full note, I'm going to end on a note of optimism. Nick, thank you very much. Richard, thank you very much.
Thank you.
Join us next time on The Investing Show. Goodbye.